Hello, folks. This is Dan Bird on Sunday, September the 10th, which coincidentally is the peak of hurricane season. So hopefully it's going to wane from here. But Mr. Zuber's not with us today. I'm flying solo, so he couldn't make it. But I'm going to do a couple of videos today. They might be a little bit briefer since it's going to be a monologue. But hopefully it'll be useful for you. So the first one, I'm just going to talk about what happened last week and most importantly, next week. CPI is coming next week. So I'll talk about where I think that's going to go. And then we'll take a look at the portfolios that I mentioned last week and see where they're at. The second video, I want to have a conversation about something that one of the subscribers sent in to me, asking about money flow and how money flow seems to be flowing out of equities. And does that indicate that we might have a crash coming soon? So we'll talk about that in the second video. So let's get started on this one. I'm going to share my screen. And for those of you who would like to receive my newsletter, it's free. I send it out every week. Actually, I'm not sending it out right now. I'm actually putting it on my website, and it's available to anyone that wants to register their email, but it is still free. Do not ask for a credit card. I am thinking about starting up an email system again and start sending out just a reminder, not the whole newsletter, but a reminder of where it is, just for those folks that are used to seeing something in their inbox. But the first thing I want to do is start here and show people how to log in if they have not registered. So just go to this link right here, Breakpoint Trading, and it'll take you to this web page. And the first thing I want to point out is I put in the IBD status up here. Right now it says uptrend under pressure as of 9/7. Anytime this changes on a daily basis, it usually doesn't change that often, maybe once a week or so. But I'll change this right on the front page. Now, the front page of the website does not need a registration or a subscription of any kind. You can just log in here and anyone can get to this. A couple of other things that are really useful here is the index charts. So if you want to see what the S&P looks like, there it is. There's a potential head and shoulders appearing again. By the way, I am not logged into stock charts, so you do not need to have a stock charts subscription to get these, although you will get the ads if you don't have a subscription. So right now I'm not logged into stock charts. I'm going to here in a second, but I just wanted to show you that it's not necessary. So that's the S&P chart. You can look at the NASDAQ, see what that looks like. Kind of similar. There's the support line down at the bottom. So we want to watch that. But that's all available without a subscription. You can get all that right on the website. Also, the books page is available. No subscription needed for this. These are just suggestions on books that if you want to learn more about trading or the market, things like that, or what other successful traders have done in the past, that's available to anyone. Also on the home page, there's a disclaimer, some testimonials. This here will always be on the front page. This is the long-term secular bull chart. I update this every week. And as long as these stay green, we are still in a secular bull market, which usually lasts about 20 years. So this one started officially in 2013. You could say 2009, which is where the bottom was, but it didn't actually break out until 2013. So we've got till 2029 to 2031, somewhere in that neighborhood, early 2030s, that this bull market should still continue to run. And then these are all the services. These are basically the pages on the website that you can go to and the different subscriptions. Now, the reason I'm showing this is because it's really important to understand that even if you register your email thinking that you're getting the newsletter just by registering on the website, there's one extra step that you have to take, and that is to actually subscribe to this $0 free newsletter registration. It will not ask for a credit card. It is free, but it does need for you to be a subscriber, even though it's free. And then the other two give you access to everything else on the website. The monthly one gets you everything except for the risk management calculator. And then the annual subscription also provides the risk management calculator. So let me show you the best way to do this. Right now, I'm not logged in. So if you just go to this website, you'll end up on this page. If you want to take a harbor tour of all the things that are on the website, you can look at it there. But if you just want the newsletter and you want to do this quickly, just click up here, click here for current week's newsletter. It will ask you to sign up. Now I've added this in because folks were not taking that extra step, or some folks were not taking that extra step to subscribe to that free $0 subscription. So I'm trying to make it as apparent as possible that you still, after signing up, still need to subscribe. So the first thing you would do is put in your email address right there, put in a password, it can be anything you want. I'm just going to make it breakpoint. There's nothing on this site that is sensitive for you. So you can make it 1, 2, 3, 4 if you want to, just something simple and easy just to get in. So now I'm going to log in. And it's going to tell me that this email does not match any account because I'm not signed up yet. So new to the site, sign up. So now it asks me for my name, my email. I'll put in again. And then once again, a password. I'm just using breakpoint as my password. And then we can sign up. Now, what it will do is ask you to confirm your email address. So it'll send an email to that particular email address. And it will ask you then to go to that email and find the code. So I like to use Gmail because Google is pretty easy to get in. So here's the verification code, and it's this one right here. So I'm just going to copy and paste that right into here. And now I'm signed up, but I'm not subscribed yet. So that's the important thing. So the next thing, it might get to this page, and some folks think that for some reason that's a mistake because they did just sign in with their email, but it's not a mistake because it actually wants you to choose a pricing plan. In this case, it's a $0 free plan. So explore plans, and you want to choose the $0 one right there. And just say get plan. And now you're in. Thanks for your payment. The payment was $0. There's no credit card or anything else. It's free. And then when you say open page, it's the same page you'll get by clicking on this. So once you are subscribed, from that point on, every time you go in and click on this little button up here, you'll get to the Breakpoint Trading market summary newsletter every week. And you'll see whether it's been posted yet by the date right down here. It usually gets posted sometime around midday on Saturday. So that's the newsletter. And if you click on that, it will just bring it up in PDF format with all the different things that you've probably been used to if you've seen the newsletters before. In this case, because it's PDF, you can make it bigger or smaller. I put this right at the top, the IBD status. And what I want to talk about is what happened last week, and more importantly, what's looking like for next week. So this is last week, fairly light week, wasn't too much going on. The initial jobless claims came in a little bit lower than expected. So that's positive for jobs, but it might not be what the Fed is looking for. So we'll see what happens with the Fed. And this is the one for next week. This is the important one. I'm going to spend a little bit of time talking about this. So CPI, you can see CPI, the previous was 3.2. It actually was 3.3. So it was reported as 3.2, but it really was 3.3. Now that went from 3.0 to 3.3, and now they're forecasting 3.6. I think that's a little high. I thought it would come in about even, maybe 3.3 or even a little bit lower, and I'll show you why in a minute. But that is a huge number. If that goes from 3 to 3.6 in 2 months, with a Fed meeting coming up in a couple of weeks, that will not be good. The Fed, that could give the Fed cover to actually raise rates again. The other thing I put in here is this little chart of the 8 components of CPI to show you what CPI is made up of. You can see energy down here. Energy had been actually increasing. So then it's a negative, but if it's going from negative 55 to negative 39, that means it's increasing. That's one of the reasons that we went from 3.09 to 3.3. But housing, as Mr. Zuber has mentioned before, housing in the next report that will be reported next week may drop significantly more. You can see how it's been dropping ever since March. Every month it's been going down. Well, the next one might go down even more significantly than this. And you can see that housing makes up 44% of the total CPI number. So again, I'm not sure why they're forecasting 3.6 other than perhaps the commodities, which I'll show you here in a minute. So here's the CPI chart. This is in the newsletter, by the way. This is the what's called the base effect. So this blue box right here is a 12-month rolling window. And I've already moved it to what the next report will show, which is this one right here. Now, last month, you can see we went from this level down, so it actually decreased. So each month, as we add a new one to the new month, we drop one off from the previous month. So if the one we dropped off last time, if this is decreasing, that means potentially that CPI actually will go up. It will get higher because we're dropping off a lower one. But this month, we're actually adding a higher one. So it's a little bit higher than the previous one. Now remember, this one here, CPI came in at 3.0. This one here came in at 3.3. If we're dropping off an equal or a little bit more than that, you would think that this would go back to 3.0. But at a minimum, should at least stabilize at around 3.3 and 3.2. So why are they projecting 3.6? Well, here are the commodities. By the way, both of these charts are on the website as an annual subscriber, and all of my charts on the website update in real time. So you can look at these anytime, any day, and you'll be able to see what they're doing. What you can see down here with commodities is the CRB, which is agriculture, energy, industrial metals, and precious metals, spiked up considerably, and oil especially has really spiked in the last couple of weeks. Gasoline actually trended down and is now kind of moving sideways, and lumber is moving sideways. So it's the CRB and oil in particular, that is really spiking up. Now, is that enough to offset the decline in housing to make the forecast 3.6? I am skeptical that it could move that much. So I'm sort of expecting 3.3 or something stable from last month. But the forecast is 3.6. So if it actually comes in at 3.6, that will not be good, and it will give the Fed ammunition. And this is what I'm talking about right here. Again, this is all in the newsletter. We are here right now. This is next week between the red lines. We've got CPI inflation report on Wednesday, 9/13. Options expire on Friday. And then the next week is the Fed rate hike. So if we get 3.6 here and we see oil continuing to go up and housing doesn't really help us out in the CPI report, we'll see, then it could give the Fed cover to raise one more time. If that happens, then all of these lines right here are from Stock Traders Almanac. These are the trends going back 21 and 76 years. 77, 78 years, 73 years, roughly. But going back through history, you can see the dotted lines are pre-election years. The solid lines are regular years. They're all kind of trending with each other. But they peak right here. Interestingly, they peak right at options expiration. They start falling off, and the dashed blue line is the NASDAQ pre-election year. They all start falling off and dropping off a cliff right after the Fed rate Fed meeting on the 20th. Now, keep in mind, this is a very long period, aggregated trend of what the market has typically done. That does not mean it needs to do it again, but historically, it has a pretty good history, pretty good track record of declining in the second part of September. And it could start right here with the Fed meeting. So keep that in mind. Be very careful about that. Also right here, this is the NASDAQ pre-election year cycle. The purple line is where we are right now. And the other lines are historically what has happened. So pre-election year is the blue one, and all years is the black one down below. So if we look at pre-election years, we are actually a little bit ahead of it. So we peaked here a little bit after the peak back here. We trended down a little bit after this trend right here. Then we're heading up. Supposedly, according to this, we're going to get a rally next week, and then it will drop off a cliff in the second half of September. And you can see right here where this peak happens is right in the second half of September, and almost exactly where the Fed meeting is. So historically, keep that in mind. This is the S&P. S&P is very similar. Purple is where we are right now, right in the middle of September. It's where the S&P peaks, and then it trends down. Now, all of these continue to trend down until the latter part of October. You can see right here. And that's when I think we will start to get a rally, when earnings start coming out for Q3, and we will rally into the end of the year, just like historically we have done in the past. I don't have October's view, but I'll have October towards the end of September in the newsletter. I will put what October looks like. So keep all of this in mind. We're in a very dangerous period over the next week. We'll see what the market does, but it wouldn't surprise me if we get a little bit of a rally going into options expiration, only because we've had 1 week straight down basically, and markets don't move in one direction for very long. So it may be a quick rally before we get to this section right here where we basically fall off a cliff for the rest of September. So be careful, watch out for that. If we look back on the newsletter, if we look at the S&P 500, this is a 1-year chart, and I've overlaid the VectorVest views. I'm going to actually log in to stock charts right here just to get rid of those ads. So now if we look at a 1-year view, we can see it's rolling over. It's below all of the moving averages, the 8-day, the 21-day, and the 50-day. All of them were below. We had the VectorVest down signals right here. They have not yet given an up signal. I'll show you that in a second. So again, very dangerous period. All of the momentum indicators are rolling over. Accumulation distribution is trending down. The weekly trend is trending down. So again, time to be cautious. We look at the NASDAQ, it's very similar. NASDAQ looks like that. And you can, again, see potentially a head and shoulders pattern right here. Left shoulder, head, right shoulder. And that would put the target down, probably down here around the 200-day moving average, if things follow through and to the downside and we do get a sell-off. Doesn't mean we will, but potentially that could happen. Just time to be cautious, because everything right now, just like what IBD said, is below the 50-day moving average, all of the averages. So it's a good time to be cautious. Now let's talk about talk a little bit about VectorVest, and then I'll show you the portfolios that I mentioned last week. So one of the things I mentioned last week when I first started to create those portfolios was that it looked like VectorVest, we were right here last weekend. So I said that the DEW signal, and I'll just change this to a DEW down here. So we got a down signal right here. Last Friday, the market had been moving up. It needs two things to happen. It needs to be above this 30-day weighted moving average, and the deep trended price oscillator down here needs to go above 0. What I said last week was we only need one up day for this to go above zero and for this to give a buy signal. And you see what happened on Tuesday. We did not only did we not get an up signal or an up day, we got 4 down days in a row. So now it is significantly lower than it was. We have a ways to go now before this buy signal will happen. Now, what I did and what I mentioned last week is that because, and this is a good lesson about anticipating the signals, you shouldn't try to anticipate signals. You should let the signals happen first. So we could call that a mistake, but this was an experiment on my part anyway. And I'll show you what the results are here in a second. But I was anticipating a signal with just one more up day, which we didn't get. So because of that, I started to buy some stocks for the portfolio. And this is a real portfolio, by the way. So this is what it looks like. There are currently 6 names in this portfolio. What I'm doing is I'm just taking a $100,000 total amount. I'm dividing it by 20, assigning $5,000 per name. And then I'm using some scans in VectorVest to identify potential candidates. And by the way, those potential candidates can be found in my website, and I actually put them down here. I'll actually show you what they look like. So these are the 6 that we're still in. These are the exits because they reached the stop price. So I always know a stop price before I buy. And you can see 1, 2, 3, 4, 5, 6 of these stopped out with a loss. One of them stopped out with a gain because I moved my stop up once it gets up to a certain point. And then if it wants to come down, it will. I never move stops down. I only move stops up. So that's what there's only one there with a gain. So what that looks like in the portfolio then is this one here is at 10% ROI. And you can see it was purchased on 8/31. So 10% in basically 3 days. It's pretty good. This one here has made it to 4.6%. It's actually made it a little higher than that. Whenever these get to 8%, I move the stop up to halfway between the buy point and wherever the high was. So I can, in this case, make at least 5%. If it gets to 5%, which Diamond Offshore did get to 5%, and you can see this one was bought on 8/30, then I move the stop up to break even. So I can't lose money on this one. Now, the other 4 down here, I could potentially still lose money, but they are still looking fairly good. So I can, if I want to look at each of these, I can look at the charts for each one. And notice this gray one down here. This is the earnings. I always want to see earnings increasing from lower left to upper right. So there's Airbnb, purchased back over here. And you can see it's had a nice run. Here's Diamond Offshore. Earnings have been going up, kind of leveling off right now. Here's ServiceNow. Earnings definitely heading higher. So that's good. It's still got a buy signal. Here's Datadog. Again, earnings heading higher down here. It's just below its 50-day moving average. So that's a major resistance area, and it does not have a buy signal yet. It's still a hold. Here's Royal Caribbean, also with a hold signal. Now, in this case, my stop price is right down here with the VectorVest stop. So it could potentially get to pretty close to that stop price, which is at $94, $97, roughly $95. And it's at 97 and change right now. So microchip technology is right on top of the stop. So this one could get stopped out just by going down a little bit more. I'd be stopped out of that one. And that's the one that looks like it's in the worst shape, actually. So microchip technology is down 4%. So if that gets stopped out, I'll be losing about 5% on that one. Just as a point of interest while we're here, one thing I do at the beginning of the year is I create portfolios just to track them for 3 dividend portfolios, basically. This is Dividend Aristocrats, which is an industry standard of companies that have paid dividends for 25 years or more and have raised their dividend every year. And if they miss that, then they have to wait 25 more years before they can re-enter. This is what it looks like right now. It's up 6%. The VectorVest has its own scan for blue chip scans for dividend stocks. It's up 1%. And then I created one of my own using my own scanning techniques. And this one is up 16%. The biggest loser on this one is down here, down 35%. And if I was actually tracking this in real time, this is not real dollars on these portfolios. But if I was, I would never have let this get to 35, down 35%. The buy price, if we go to a 1-year chart, it was back here on January 3rd, right here. So it was purchased right there. Probably when it dropped below the 50-day moving average, somewhere around here, I would have been out. Somewhere in this range, instead of waiting for it to come all the way down here. But the purpose of these portfolios is just to pick some stocks, in 10 in each case. So it's the top 10 in each case, and just ride it out, see how they do over a 1-year period. And some of the big losers are offset by some of the big gainers. And you can see that all of these gainers are energy related. So because energy has had a good year, these have also had really good years. So that's just give you a sense for what the portfolios look like. This one here is the one that we're tracking. May get stopped out. I will not buy any more for this portfolio. So this one theoretically could have all of these stopped out. Some of these will be stopped out with gains. Some of them may be stopped out with losses. We'll see what happens next week. But I will let those be stopped out until I get a buy signal over here on this market timing graph. So both of these things will have to come back up before I start adding more to that portfolio. So we'll see how it goes. We'll keep tracking that and check in with it every so often. All right, so that's about it. That's about all I've got for today. Again, breakpointtrading.net. If you go out there and the homepage, you can always get to, even if you don't register, and you can look at the NASDAQ or the S&P or anything else. You can see that there's potentially another head and shoulders forming here. But again, it doesn't complete until it breaks through this support line down here. So we'll continue to watch that, but very dangerous week. We really need to be careful and watch the market, see what it's doing. You can look at Bitcoin here also. Just went up and then came right back down to the support level that it's been sitting on for quite a while. So we'll see what Bitcoin does. But that's the website. You know, there's a lot of stuff in there, especially if you are an annual subscriber. There's a ton of stuff that you can have access to. I'll show you some of that in the next session when we talk about money flows and whether the money flow out of equities may be signaling coming crash here soon. I'll talk about the next video. So hopefully that was useful. Mr. Zuber hopefully will be back next week. Go to breakpointtrading.net and log in. Don't forget to subscribe to the $0 subscription, not just logging into the site, but subscribe to the $0 subscription as well. And you'll get access to the newsletter every week. That's it. Thanks, everyone. Appreciate everyone joining. And I'll talk to you in the next video.